My name is Matt Krajna, co-CIO here at Nottingham Advisors. Wanted to spend a couple minutes and recap central bank activity over the past week. A lot of central banks reporting interesting insights into their views on monetary policy and the overall health of the global economy. Let's start with the Federal Reserve. What did the Fed do this week? They left their target rate unchanged, 5.25% to 5.5%, largely as expected. Didn't offer a lot of new news. They did do a couple things. They did increase their GDP estimate for 2024. They did raise slightly their estimate for the neutral rate or longer-term interest rates over the period of time. Ultimately, interest rates moved around a little bit depending on where you are in the curve. Short-term rates fell on the news, largely as expected. Intermediate rates largely stayed flat, while ultimately, as expected, longer-term rates on that longer-term outlook did raise a few basis points on the long end. What I would say here when we think about overall central bank positioning is banks are starting to kind of feed the market's enthusiasm here. They're starting to coordinate themselves for the back half of the year on what we think could be a coordinated effort to cut interest rates. We saw the Bank of England this week stay on hold. We saw the Swiss National Bank cut interest rates. We saw the Bank of Japan largely exit negative interest rate policy. That's been the big elephant in the room for the past handful of years, has been the impact of zero and negative rates on global risk assets for a longer than expected period of time. Thankfully, we're out of that experiment. We're on to markets being able to stand on perhaps their own 2 feet. And so really here for risk assets with markets at all-time highs, I do see this possibility that in the second half of the year, banks are coordinated. They're cutting rates from a position of strength. Largely, banks have cut interest rates over the past from a position of weakness, needing to cut rates to stimulate the economy. Here we have an economy that's largely stimulated, standing on its own 2 feet, cutting from a position of strength, almost as an insurance policy. So I view that favorably for our portfolios. I view that favorably for risk assets. I really do think that the market is in a good position looking out for the balance of the year. To think about these in more detail, please contact our team here at Nottingham Advisors or visit our website at nottinghamadvisors.com. Thanks.